Dear investors, greetings. Welcome to just yet another market outlook for the month December 2022. Here we go. Indian equity markets just closed with notable gains, probably mirroring the supportive global cues. And in the subsequent slides, we are going to say as to what are all those global cues. And BSE Sensex, maybe if you just look at the 1 year change, it has gone up by 5.27%. Nifty 50 ended with 5.24%. Mid caps have just gained by 2.78% for the whole year 2022. And small caps have ended negative. And Bank X has gone up substantially by 22.68%. If you look at the BSE Sensex, it ended at close to just 61,000 for the month December 2022. And in a nutshell, we thought of giving some inputs on how the domestic equity has been just positioned at this hour. See, like Indian Railways earned around 1,05,905 crores from freight loading alone till November. It is up by 16% on the year-on-year basis. Direct tax kitty is up by 31% at 10.5 lakh crores. India's forex exchange reserves just got into a faster surface. And of course, it has the other side. We'll just touch that later. India is one of the two places globally to just witness growth in steel consumption. Is yet another very interesting input. 97% mobiles used in India today are made in India compared to 8% in 2014. And India is now the biggest smartwatch market in the world. India's electricity consumption grows 14% to 112.81 billion units in November. And India incorporation's profit declines sharply to 3.48% of the GDP, which is one very important news which everyone has to just keep in mind, because we talk about positives as well as negatives in this market outlook. Manufacturing shrinks, and again, actually, there is yet another input, and maybe just if you look at the overall, actually, just S&P Global India Manufacturing Purchasing Managers Index, which we call it as PMI, it stood at 57.8 in December, up from 55.7 in November, which is a very welcoming sign because the business conditions improved to the greatest extent in last 2 years. Again, the PMI index for the services sector also just went up. It improved to 58.5 in December vis-a-vis 56.4 in November. And trade deficit, look at the thing, it slumps by 17%. And these were the observations in the domestic equity at this hour. See, just overall, the market breadth on BSE was strong with 2,539 scripts advancing and 971 scripts declining. A total of 121 scripts remained unchanged. That shows it's going to be a broad-based rally now. And a price to earning and the dividend yield is as follows, right? Maybe as on December, you look at the broad-based indices and the price to earnings is hovering at 23.7. And the dividend yield ranges at 1.17. That's of Sensex. And you look at the foreign institutional investor flows or the FPI flows, the inflows are negative, okay, for the year till date. And you look at the mutual fund flows, which is hovering at, say, just how positive it is at 1,81,178 crores kind. And look at the other economic indicators as to just what is the consumer price inflation. The consumer price inflation, which is a main indicator of the inflation, you look at right now it is 5.88% vis-a-vis 4.91% a year ago. That means it has gone up. And again, the index of industrial production, which was minus 4%, you look at the figure, it's a phenomenal figure. It is positive by 4.2%. Look at the gross domestic product of us, the GDP, which is a main indicator for the economic growth, was actually just right now is at 6.3%. vis-a-vis 8.4%. That means we are down sizably when it comes to GDP. Again, you just look at actually just India's capacity utilization, which is at 17-quarter high. That means we are able to produce more within India. Credit growth is reviving to double digits right now. You look at the main thing, actually just how it just grows. Non-food credit, you look at the way it has just grown, which is indicated in blue. And look at the industrial growth. how it is this industrial credit growth, how it just revives. It stands at 13.6%. Look at the retail loan, probably just it fell down a bit and it is going up. So that means just irrespective of the interest rate, the retail loans or the personal loans are going up. India has delivered far better return than its peers. That means, we have just done a comparison vis-a-vis the emerging markets, and we have looked at different periods. See, because normally the foreign portfolio investors wants to just invest in any country for a longer period. Even though actually the FPI flows in last 1 year seems to be very negative, you look at these figures, which makes India as a compelling option to just invest. You look at different periods, 2003 until 2022. What's the kind of absolute returns India has generated? That is a whooping actually 1162% vis-a-vis rest all emerging countries. And again, 2010, the absolute return made in India since from 2010 until 2022 stands at 98%. You go with the CAGR returns, that is a compounded annualized growth return or the calendar year return. You look at the return, which makes India as a compelling option for any foreign portfolio investor to invest in India. Again, what's negative? Because we go to the global equity and we talk about the global negative cues, probably the fears of a potential recession, maybe especially US, UK, Euro. As he said in November outlook, that is poised for a very potential recession. The rate hikes are happening across the countries, across the globe. Resurgence of COVID-19 cases in China. So that is one thing, and drag down the indices. And again, actually, just you look at different markets. Maybe even though it fell down, it marginally went up as well. As China just said, like China eased most of its COVID-19 curves and is supported global markets. Again, just look at the global index across the globe, maybe just for the month of December. So look at Russia with Russell 3000 just advancing a bit, and it's marginally negative. The change is 0.96%, that is minus. And NASDAQ is negative by -1%. FTSE is just positive very marginally. And Nikkei is positive very marginally. And Hang Seng is just negative very marginally. And look at, we tried just giving country-wise in a nutshell. So US equity in a nutshell. So just most tech layoffs have happened. So that have been announced in this year post 2001. And again, US credit card debt grows 15% all-time high of whooping $930 billion. Wells Fargo mortgage business drops by 90%. And $30 billion collapse of crypto exchange, as you know well. 37% of small businesses in US unable to pay rent. Amazon founder Jeff Bezos wants a recession is looming and Americans should prepare for the worst. And Fed may slow down the pace of rate hikes. So as of US is concerned, see, just look at the way the interest rates have gone up across periods. So just on a month-on-month basis, how it has just gone up, how it is likely to just fall down over a period of time. This is what it indicates. So it's very clearly right, Fed is caught between devil and the deep sea. And Europe is going through tough times. UK inflation rises to 41-year high at 11.1%. Millions forced to skip meals as UK cost of living crisis deepens. Nearly half of UK families are left with less than €3 a week. UK restaurants are going bankrupt at faster rate than during COVID. This is something so very important. And again, long-term investors staying away from China exposure. BlackRock shelves China bond ETF, and Tiger Global passes investments in Chinese equity. Coming back to the domestic debt, which is a very, very important kind of a subject. The bond yields fell, maybe just it followed a upbeat demand at the auction of the state government securities, and yield on the 10-year benchmark paper, which is 7.26%, inched up a bit. Okay, it closed at actually 7.31%. Maybe these are the other indicators of the domestic debt. You look at actually just a 1-year commercial paper, which is in the range of 7.87%. 3-month, maybe just the 3-month actually just carpet deposit, you look at the way 6.6%. And look at the way the other indices are, maybe just in the domestic debt. It is all actually just marginally just high. Looking at the current trend, maybe just interest rate hikes may or may not happen, but it is going to be at this high interest rate regime for some more time. So you look at the crude oil, which actually just marginally just relaxed a bit. Maybe just look at the way, maybe a year back, it was hovering at $75 per barrel, and it is inching in the range of $79.35 per barrel. Brent, which is the main indicator, is hovering at 84, which is substantially high from the year from a year ago kind of a point of view. Look at gold, actually just maybe just we are planning to just give an idea on gold as well. Gold as well as crypto, as many clients, many investors were asking the view on that as well. So look at the gold, it is almost hovering at the same level before a year as well as now. Maybe marginally higher. If you look at actually just maybe if you look in terms of rupee, it is marginally higher. Maybe how is the global debt position at this hour? Maybe US Treasury prices fell sharply in a holiday. Maybe just as China continues to just work on maybe just the COVID-19 restrictions, and the sentiments for the yield boosted after China just probably informed that it is not going to just get into quarantining and all kind. So the yield of the 10-year benchmark Treasury bond maybe just is hovering at 3.84%, which is high from 3.75%. So across the globe, the interest rates are going up. So what's the latest news is the question now. So India's core sector output grew by 5.4% on year in November compared to 3.2% growth the same month last year. India's fiscal deficit for April-November 22 came at 9.78 lakh crores, accounting to 58.9% of the fiscal target, which is relatively high, as you know. And according to RBI, India posted a current account deficit of $36.4 billion, which is up actually just which is 4.4% of the GDP in the second quarter, relatively very high, as you know well. Maybe the previous quarter ended at 2.2% of the GDP. IMF expects India's economic growth to slow to 6.1% in fiscal 2024 from 6.8% as projected earlier. Maybe just the global cues, as you know very well, such as high oil prices, weaker external demand, and tighter financial situation given the inflationary conditions. The finance minister's quarterly report on public debt management also showed total liabilities of the government increased to 147.19 lakh crore, right? Just which is relatively high vis-a-vis the last year kind. And cabinet also approved actually the revision of pension of armed forces, right? Under the one rank, one pension. So that's a good news to the army force. And the financial stability report stated that India's banks and non-bank lenders are in a position to withstand even the worst of the macroeconomic stress emanating from global spillovers. Let me reiterate this point. RBI's FSR, we say, that is Financial Stability Report, stated that India's banks and non-bank lenders are in a position to withstand even the worst of macroeconomic stress emanating from global spillovers. SEBI just initiated a detailed study of existing regulatory provisions applicable to fees and expenses charged by mutual fund. This is an important kind of an announcement which we'll have to just remember, because over a period of time, SEBI has been just reducing the fees on the mutual fund schemes. 78% of the total Bitcoin units have not been transacted since 6 months. You know, like actually just this is a bigger news because many investors kept on asking as to just what is the latest news when it comes to cryptos, because few have just relatively invested it as well. So that is one thing. Let me just skip and just come to this slide. Yeah. So Sam Bankman-Fried, co-founder of FTX, lost 94% of his net worth in one day. So this is the latest trend of the crypto market. Maybe the cap slumps to just under $1 trillion, $1 trillion, I'm sorry. So just look at the some different periods from 2013, how it just went up and how it is hovering at this level. See, just 2021, cryptos were hovering at $2.26 trillion market cap. vis-a-vis $833 billion, which is relatively very, very low. So what it indicates, because anything that is not coming under the regulatory ambit tend to suffer. So cryptos are clearly not under the regulatory ambit, as everyone knows. And gold and Fed rate share and very inverse relation. This particular chart is very, very interesting because those clients or those investors who would love to know as to what is the correlation between gold, maybe just gold in terms of dollars and the Fed rate. So you look at the different periods of time. So the gold is indicated in a blue line and Fed rate is indicated in the maroon line. See the way actually just they are inversely correlated. This will give you an idea whenever the Fed rate goes up, what would be the condition of the gold in terms of USD. India story, are we an island in an ocean of gloom? So we need to see just the kind of it is. Maybe there are a couple of indicators which gives us so much of confidence when it comes to India. See, Morgan Stanley Composite Index, emerging market index is on the rise when it comes to India. Look at different countries and the way the allocation has just gone up. If you remember, during the COVID time in the webinars, we have just told that the allocation by the Morgan Stanley Composite Index, which is a global index, the allocation to India will go up. That's what we said. And it has happened also over a period of time. See, just during COVID, our weightage was around 7.7. It has gone more than double, as you see here. And what is the way forward? This is a question which many investors ask us as to what are the key risks to the markets of this are. When I say markets, I try relating to the equity markets here. See, just the growth outlook looks good, but there are other parameters of inflation, fiscal deficit and trade deficit, which look so worrisome. And valuations are lined for the market from an all-time, just from an overall standpoint. And we are not too, that is, we are neither too lowly valued nor too highly valued. So that makes India even more a compelling option. But having said that, actually just a lot of global market cues are very negative. So whomsoever wants to invest in lump sum, we would suggest you to just follow the route called systematic transfer plan. And again, actually just maybe just start investing more via systematic investment plan, because it is going to be a very, very lucrative markets to participate. And whomsoever has not participated in the direct equity journey, I'll suggest you just, if in case you have not started, better just start the earliest. And again, the disclaimer is please, we have not suggested any of the schemes here. And also actually we have not suggested any of the categories. We literally say just consider looking at equities in a staggered way, as well as consider investing in debt funds, as we feel like going forward, India inflationary thing is known, given our domestic consumption. Having said that, when you look at the interest rates, whether it goes up or not, it is going to be at this level for some time. Make best use of those opportunity. And is it going to be a roller coaster ride? Yes, it is going to be. That's the reason actually we say just better participate in systematic investment plan in equities, especially in mid cap and small cap, as it is a good opportunity market. And again, you can also just start considering debt funds, especially the duration funds for the systematic investment plan, as it can be a good alternate to your long-term recurring deposit. And thank you so much for joining us, and let's make investing interesting. And I hope that this particular session would have benefited you a lot. Thank you so much, and see you once again. This time we are planning to float yet another video to give you a forecast as to just how 2023 markets are positioned at this hour. Thank you so much for joining us.